Hello, everyone, and welcome to a special presentation on capital allocation. I am Grace Portfleet, a second-year student at Quinnipiac University and volunteer of Game Forum. Our speaker for this presentation is David Giroux, a portfolio manager in the U.S. Equity Division of Rowe Price. He manages the capital appreciation strategy, including the Rowe Price Capital Appreciation Fund. He also serves as the firm's head of investment strategy, Chief Investment Officer for Equity and Multi-Asset, and co-chair of the Equity Research Advisory Committee. Giroux is a 5-time nominee and 2-time winner of Morningstar's Fund Manager of the Year Award. He holds a Bachelor of Arts, magna cum laude, in Finance and Political Economy from Hillsdale College, and he holds the Chartered Financial Analyst designation. Please give a warm welcome to Mr. David Giroux.
Hello, everybody. Hopefully, everybody can see the presentation. And again, looking forward to the presentation today. Looking forward to the Q&A as well. If Grace or Jacob, if people can't see the presentation, please let me know. But if not, I'm going to go on the assumption that people can. So I'm going to just do a very brief introduction. Grace touched on many of my roles at T. Rowe, so I'm going to go to the second slide. I've been with T. Rowe since 1998. I came right out of undergrad into T. Rowe. I was an associate analyst for about 18 months. Actually, it's a little error here, but in 2000, I became an analyst at T. Rowe. I covered our industrials and machinery, building products, and auto sectors. In 2006, I took over our cap appreciation fund, which I continue to manage today. Back when I took it over, it was about $10 billion in assets. Today, we're about $80 billion in assets. In 2017, I became our chief investment officer. And in 2018, I became the firm's head of investment strategy. Before I jump into the presentation, maybe just take a step back. When I was in college, I didn't think I was going to be an investor when I went to college. That was not my career path, or at least my plan at the time. It was really my sophomore year of college. I started reading some books on investing and really fell in love with the idea of investing. My first book was One Up on Wall Street by Peter Lynch. And that helped me decide I wanted to be a finance major in college. And really over the next 18 months, I read, I think, about 40 different investment books, a lot of books about people like Ben Graham, Warren Buffett, again, Peter Lynch. Those books, in many cases, helped me, help build my investment foundation, how I think about investing, how I think about creating value. But they help me, think about how you read a balance sheet, how you be a contrarian investor, the importance of the statement of cash flows, earnings quality, all these things. But interestingly, those 40 books that were integral to how I thought about investing at that time, they really didn't touch on capital allocation a lot. It wasn't an important topic for any of those books. And honestly, really until 2000, when I became an analyst, when I became an industrials analyst, this idea of capital allocation really was not something I focused a lot of my time or attention on. It wasn't that we talked a lot about it as a group. As analysts or associate analysts. And it was really kind of in 2000 where I became this industrials analyst, where I was taken to a room with Bill Stromberg, who was our director of equity at the time, research at the time, and a gentleman by the name of John Wakeman. And they kind of introduced me to these industrial companies. They said, these industrials, they kind of grow, 1, 2, 3% a year. But then they generate a lot of free cash flow, and they deploy the cash flow really either really well or really poorly. But if they do it well, they can kind of be a double-digit grower and create a lot of value over time. And I would say I was very, very skeptical at the time. I was a little skeptical of kind of these companies that were kind of roll-up stories. But but it's funny looking back 20 years, more than 20 years from that meeting with Mr. Stromberg and Mr. Wakeman, and looking back in my career. I would say a lot of the success I've had as an investor is really because I've kind of identified companies that deploy capital well, and basically making large bets with those companies, holding those bets for a long period of time, and seeing those companies, in many cases, get better and really create a lot of value for our shareholders. Again, it's still, and what's also very interesting is, again, even 20 years later, this topic of capital allocation is something that rarely comes up. Doesn't come up with meetings as much as it probably should. It doesn't come up in the media, from the sell side, or even on boards. It's just not as big a focus as it should be. And we'll talk about why I think that's a mistake. But before I get too deep into that discussion, maybe it makes sense for me to we'll start the presentation on slide 3. Again, hopefully everybody can see this, and we'll just talk about what is capital allocation. At its very basic level, capital allocation is defined as the process by which management teams and boards deploy their financial resources both internally and externally. And on the next slide, we'll talk about some examples of capital allocation. But at its core, capital allocation involves an outlay, an investment, whether it be cash or shares in a company, and should be expected to generate an attractive return for shareholders on the investment over a reasonable amount of time. In many cases, that investment time horizon, most of these I talked to today talk about year 4, year 5, year 6, year 7. And over that period of time, we want to generate very attractive returns on our capital that we deploy. This last point's important, though, and this is what makes capital allocation hard. Firms don't have unlimited resources, but they also don't have unlimited bandwidth. There's only so many managers, and they don't have as much time as they probably would like to do everything they would like to do, right? So thus, companies have to make choices about where they deploy their financial resources, and also where they deploy management's time. We always, if you had a situation where a management team had, they could do $1 billion share repurchase, or they could do 4 deals, 4 acquisitions. One will take very little of their time, one will take a lot of their time. If the returns on both of those are similar, from a return on invested capital standpoint, you probably favor the share repurchase because management will have more time to focus on the core business and less time kind of integrating 4 acquisitions. So let's go to but this idea of ROTS, return on time spent, I think it's a concept that also doesn't get enough attention, right? Management's time is not unlimited. So let's go to we'll go to the next slide. And we'll just talk about some examples of capital allocation, right? And maybe talk about some numbers around it. So I decide, or a company decides they're going to build a plant, right? The plant's going to cost $10 million. In year 4, what's going to be a return on that plant? How much free cash flow will that plant be generating in year 4? If it's $300,000, 3% return on capital, not great. If it's 7 or 8, maybe it's okay. If it's 12 or 15, probably very, very good. You want to go ahead and build that plant. Expanding into a new geography or market, right? We're gonna diversify our business from breakfast cereals into frozen waffles, or we're strong in the U.S. and Canada, but we want to get into the U.K. market or the French market or the German market. That involves an outlay of an investment, and when will we start generating a return on that investment over time? Increasing or decreasing an R&D budget, right? What are the returns you're getting on that R&D? If we add more money to the R&D budget, what is the expected return on that incremental R&D that we're spending? Making an acquisition, very much like the plant, right? Spend $10 million in acquisition. What is the return in year 4 on a cash-on-cash return basis? If it's, again, $300,000 on that $10 million acquisition, pretty poor. 7 or 8, maybe it's okay. 12, 15, or double digits, probably pretty good. Paying a dividend also is kind of a capital allocation decision. And repurchasing shares, in many cases, this idea of comparing all the different alternatives and the expected returns. I can build a plant, get 1 return. I can make an acquisition, get another return. I can increase the R&D budget, get a certain return, right? Where are the returns the best? Not only where are the returns the best, but where is the highest return that we can get? So let me go to the next slide. And so this goes to this idea of why is capital allocation so important, both from investors, but also from companies, boards. Why is this so important? I think the most important thing I would tell you is most companies unfortunately deploy capital suboptimally. There's almost like a bell curve, if you will, but the bell curve is not good. The center of the bell curve is not good, right? There's some companies that deploy capital extraordinarily poorly and consistently did it, have done it or continue to do it. There's a lot of companies that kind of do it just a little bit below average, right? Or don't generate attractive returns. And there's a handful, maybe a couple of handfuls of companies that do it really, really well over time, and who've created a lot of value through that having that differentiated kind of capital allocation. The second bullet point I would talk about is if you go back 30 or 40 years and you look at real GDP growth in places like the US, Western Europe, Japan, Australia, even if you look at most of the rest of world economies today, the emerging markets, all these economies have kind of slowed on a structural basis. If you use real GDP growth as a proxy for the organic growth rate of a stock market, which is probably a good way to think about that, that would tell you that the organic growth rate from a revenue perspective for most market participants, most companies, has come down dramatically. Maybe it's coming down in half. But there is a good side to that. If, in an environment where you're growing organically at 3 or 4 as a mature company versus 7 or 8, you have a lot more capital left over. You're generating higher free cash conversion. You don't need as much CapEx. You don't need as much working capital to support your growth. But as a result of that, the returns you generate on that excess capital become a very, very large part of your total shareholder returns. We'll talk about it later. So again, capital allocation and the deployment of excess capital is going to be a greater and greater part of total shareholder return. At the same time, when companies are not doing it really well. And again, the last bullet point I would tell you is most investors, and I would say just the market in general, do not focus on this topic, which really creates a market arbitrage for longer term investors. Again, there's a lot of things in the market. There's a lot of noise in the market that the market focuses a lot of time on, attention, trades on, that really in the whole scheme of things aren't that important. There's other things in the marketplace that are really important the market doesn't focus on, right? Especially things that probably impact longer term shareholders. So I would tell you as an investor, a potential investor someday in the future, spend less of your time on the noise and more time on things that really matter to the total shareholder return on a longer term basis, right? And again, capital allocation is really is one of those things that market doesn't focus on. You should focus on. I think is a critical to kind of creating value for shareholders over a long-term basis. All right, so let's go to page 6. And again, this idea that most companies, the historical record would tell you that most companies deploy capital suboptimally. Think about share repurchase, right? Share repurchase activity, I think went up by about a factor of 4x, maybe 4 or 5x. From like 2003, which was the trough of the market. The market was very, very cheap in 2003, to basically to 2007. It took, and then the market peaked and fell 60% in the peak in 2007 to the trough in March of 2009, right? Share repurchase activity fell off a cliff. So companies were really aggressively buying back their shares when they were expensive in Q2 and Q3 of 2007. In March of 2009, when the share prices were really attractive, when stocks were trading at 13 times earnings instead of 20 times earnings, they weren't buying back their shares as aggressive as they should have been. So again, it's almost like going to the, if you told your spouse or your boyfriend or girlfriend, I only go shopping when nothing's on sale. I can't go shopping when everything at the grocery is on sale, right? I think you kind of be laughed out of the room. But that's how, I think in some cases that's how boards and management teams think. They say, I want certainty. I want to feel like the economy's good before I deploy capital. The mistake is your returns can be really, really poor when you're doing that. The company that is very willing to buy back their stock at 20 times peak, but is unwilling to buy back their stock at 13 times trough, when the returns on those are very, very different. Capital spending. Capital spending, especially in cyclical industries, tends to rise in the mid to late part of an economic cycle. And by the time the demand comes online, it's often a situation where you don't need that capacity. The returns on that incremental capacity you put in place are not great. You've seen this happen in many material industries, metals. You've seen this happen in oil and gas, and I think right now, actually, you're kind of seeing it happen in the semiconductor industry, where we went through a period of time where, still today, probably, where goods has taken a tremendous amount of share from experiences and services. So, durable good demand in this country, and probably globally too, is probably 20% above normalized, below 19 levels. Because we've all gone out, we've all bought new computers, we've bought new exercise equipment, maybe new TVs, new appliances, because we're living in our homes more. We're valuing that time, and so global supply chains, semiconductor manufacturing was never set up to go from X demand to 1.25x demand. At the same time, we've had kind of COVID-induced supply challenges coming out of Asia. If you have like a 2 to 3 year time horizon, which you should, it's likely the demand for durable goods will probably go back to kind of normalized levels. Some of these supply chain issues in China will get better from a COVID reduced. So you probably won't have a semiconductor shortage. But what's happening in the semiconductor industry today is every company out there is saying we gotta put a whole bunch of new capacity in place, and it'll come on in the next 2 or 3 years. So it's like you see this pattern over and over again, where people feel like demand's really strong. By the time they put a new capacity in place, new capacity comes in place, the demand's not there, returns are poor. Companies that deploy a lot of capex or increase their capex the most tend to systematically underperform on a 1, 3, 5 year basis. And again, acquisitions is the same. It's the same dynamic with share repurchase and capital spending. Most acquisitions happen late part of the economic cycle. They peaked kind of in 2007. There was very little share acquisitions done in early 19 when things were really early 2009 when things were really attractive. And again, so you're buying high, and you're unwilling to kind of make acquisitions lower. And again, the vast majority of acquisitions, well more than 50% of acquisitions, don't actually fail to generate a return above the firm's cost of capital. And again, I would argue that generating a return equal to a firm's cost of capital is a very low benchmark, right? A very low threshold, right? If your cost of capital is 8 and you do a deal and takes a lot of management time and involvement, and 4 years later it's 8% return, that's not a great outcome, right? That's not a great outcome. So I would also say the historical evidence is, again, companies that spend the most in capital from a capital spending perspective and acquisitions, their returns of capital, their share price returns, their margins tend to do really poorly. The evidence historically on share repurchase has used to be really good, but in the last decade it's become much more mixed, as we've seen more share repurchase, and probably share repurchase with companies who shouldn't be doing share repurchase, in all honesty. All right, so let's go to slide 7. And slide 7, I think, is really one of the most important slides, because it really highlights this importance of 2 things that I pay a lot of attention to as an investor. What are the returns on the capital you're deploying, that excess capital you're generating, you're deploying, and then how much capital are you generating? So how much free cash? What's your free cash conversion, right? $1 of earnings with only 60 cents of free cash flow, you can't redeploy earnings. You can redeploy free cash flow. You can't redeploy earnings, right? So if all your earnings growth is being sucked up by capex or working capital or other things like that, or restructuring, you can't really redeploy capital, right? You need physical cash or debt capacity to essentially have capital to deploy, right? So think about a company that has 4% organic growth, 4% EBIT growth, earnings before interest and taxes, right? 4%. If they deploy capital and they do deals and they get a 6% return on capital in year 5, which is not great, probably below their cost of capital, below what they can do on all other alternatives, and they only generate for every $1 of earnings 60 cents of free cash flow, their EPS growth rate should be about 6.5%. If you had a similar company, same organic growth rate, same 4% kind of EBIT growth on an organic basis. But they were able to generate 10% returns on capital. And for every dollar of dollar of earnings they had, they generated $1 of free cash flow. Their earnings growth would be 11.2%. That's almost 500 basis points faster EPS growth than the company that had the 6 and 60, if you will, versus the 10% return on in year 5 and the 100% kind of free cash conversion. And the compounding effect of it, the difference between 11.7 and a 6.5, the company that's doing 6.5, it'll take 11 years for that company to double its earnings. The company that's doing 10% return on capital and 100% free cash conversion, and they'll do it in more like 6 years, 6.5 years, honestly. So again, I think, find companies that deploy capital well, they generate good returns on their excess capital, and have a lot of capital to deploy because they generate high free cash conversion. And we'll talk about some examples of this in an upcoming slide. So let's go to the next slide. And again, I talked about this already. Again, most investors really don't focus on this. It's just not something that is top of mind for so many investors. If you go through most of the sell side models, when I mean sell side, I mean kind of investment banks, right? The JP Morgans, Bank of America's, Goldman Sachs sell side models. Most of them don't model forward capital deployment, right? They haven't, the company hasn't announced anything, so we're not going to deploy anything. So you see these crazy models where the company has $1 billion of cash today, and you look at the model in 2024 and they have $10 billion of cash, right? But that's probably not what they're going to do with the capital. They're probably going to buy back stock. They're probably going to do acquisitions. They're probably going to do something with that. So the earnings in those cases is probably understated, because hopefully the companies will be able to do something with the capital better than putting cash on the balance sheet earning 1% or 2%, right? Hopefully they'll be able to find something that generates better returns than that. I would say most investors, especially most of the sell side, if you ask them, what is the total shareholder return algorithm of a company? They can't do that. They couldn't walk through it. They can tell you what the top line growth is. They really couldn't tell you what the total shareholder return algorithm is, which is surprising, because when we think about every company we invest in, we kind of think, okay, we start with that total shareholder return algorithm. And on a future slide, I'll spend some time and I'll walk through how to think about that from a total shareholder return perspective. And again, this last point, I think it's really important. Again, the market obsesses about the organic top line growth of a company. But I'm sure, again, what everybody learned in Finance 101 is, what the value of any company is the present value of its future cash flows. It's not the present value of its future organic growth rate, right? It's the present value of future cash flows. And so you find these very weird situations where you have a market that's obsessed with organic growth rate. You can find a company that is basically taking all its excess capital and basically deploying it into R&D projects. Basically buying companies that are early stage companies, and those companies have a nice organic growth rate, so it blends over time. It blends into a nicer organic growth rate. So but you don't earn almost any. You don't really generate really good returns for that for the first couple of years, right? And maybe not even over the 5-year period of time. So you have a company that's basically generating, let's say, 7% EPS, a 7% organic growth rate, but it's only generating 8% EPS growth, because there's not a lot of margin expansion inherent in that model. So the market say, wow, we love that 7% organic growth rate. We're going to put a 25 multiple on that. You can also see situations where you see companies, like some of the companies I mentioned before, where you have a 4 to 5% organic growth rate, but you're improving margins a little bit every year. You're deploying the capital, you're getting higher returns, and you're actually able to grow earnings at a double-digit clip, as we talked about before. So you got a company, and that company might only trade for 20 times earnings, but that's an arbitrage opportunity, right? That company that's growing at 7 with 8% EPS growth, trading for 25 times earnings, their future cash flows are growing at 8. The company that's growing at 4 to 5% organically with double-digit EPS growth, they're gonna compound wealth, even if the multiples stay 5 points apart, 200 bips, 300 bips faster than that other company. So I think that's an arbitrage opportunity for investors. And we'll talk about some examples of companies that have exploited that over time. But the point is, there's more to a company than its organic growth rate. It really is. And that's really important, especially as we talk about mature companies. And I would say most companies in the market today are not Tesla, are not Apple, are not the SaaS software companies, right? Most companies are relatively mature companies that they kind of grow at kind of GDP-like kind of growth rates, right? That's the majority of the market. All right, so let's go to the next slide. All right, so I went too far there. All right. So I have a list here of a number of companies that are, if you look back over the last 20 years, these are companies that have outperformed the market somewhere between 200 bips to 2,300 bips. BIP is, if you think about the markets over the last 20 years is up 464%. But the lowest name on this company is Texas Instruments, which is outperformed by 600. So they've outperformed the market by 230%, or 230 points, if you will. But then you have other companies like Thermo and Amitech that have almost beat the market by a factor of 6 or 7x over that period of time. And that's really, really, really powerful, right? The compounding and more than doubling the CAGR return of the market over that period of time. And again, all these companies on this list, Texas and Thermo, Danaher, Perkin, Roper, Amitech, AutoZone, Pfizer, none of these companies over this period of time grew organically faster than GDP on a nominal basis. These were, until recently, maybe Danaher and Thermo have escaped that, but most of these companies have kind of grown at like a GDP-like kind of organic growth rate. But they still generate a tremendous amount of value for their shareholders, vastly outperforming the market over this period of time, and you create a lot of value for their shareholders. And so we're going to talk a little bit on next slide about how they did that. And so let me start with Texas Instruments. We talked about semiconductors a little bit before, but Texas Instruments, if you go back 10 or 15 years, really 10 years ago, most semiconductor companies were, I would call, obsessed with smartphones. And they had a lot of what I call commodity chips that went into smartphones. And then even some of their non-commodity chips, they were spending a lot of their R&D dollars on focused on that smartphone market. Texas Instruments correctly saw that market was going to mature, and that was a less good business. You can get a socket, or you can basically get your chip placed in an iPhone 1 year, put a lot of R&D in that, it's lower gross margin, and then next year it can be taken out, right? So there was no guarantee that chip would stay in. So Texas decided to divest a lot of their commodity businesses, many that were tied to smartphones. They decided to do what, they decided to put more of their R&D dollars in auto and industrials. Their view was at the time that if I get a chip in a Mercedes or a Camry or something like that, it's likely that chip's going to stay in place for the next 5 or 10 years, right? If I get a chip put in an air conditioning unit, probably going to stay in there for 10 or 15 years, right? So there's a long annuity. So I can kind of build these long annuities. So the companies aren't going to redesign the air conditioning unit and change the chips out every year, like Apple might do with their phone per se, right? And so they really kind of still had some focus on smartphones, but spent less R&D dollars there because the returns were less, and put more R&D dollars in industrial and auto. And if you look at over the last 7 or 8 years, they've taken massive amount of market share in the industrial and automotive end market, whereas those end markets kind of had grown, let's say, units, mid-single digits. They've kind of grown strong double digits consistently in both those end markets. And again, the other thing Texas did that was really interesting is they returned all their excess capital to shareholders. Instead of doing a lot of deals, instead of spending all their money on CapEx, they returned all their capital to shareholders. And what's really interesting is they basically, what they did 10 years ago, everybody else is kind of trying to do now, right? Everybody else has kind of copied them. So almost all semiconductor companies, ADI, NXPI, all these other companies, they're basically returning all their excess capital to shareholders. They're focusing on auto and industrial, but they were first to that strategy. And they created a lot of value and outperformed the market dramatically during that period of time as a result of that. Thermo Fisher's is an amazing story, probably one of the most amazing companies from a capital allocation perspective that I've ever come across. And again, a very large holding of mine to this day. This is a company that basically, when I started investing alongside this company, basically 10 plus years ago, it was a 3 to 4% organic growth company. And they basically, through what I call counter-cyclical capital allocation, which again is very rare. Again, most capital allocation is pro-cyclical. Make the deal when things feel good, pay high multiples when things feel good. They bought an acquisition in 2014, Life Technologies. At the time, Life Technologies had kind of gone from growing 7 organically to 2, because there were some transitory issues with the NIH budget, which impacted their sales, but it's very, very transitory. And Thermo was able to kind of buy this thing for 13 times EBITDA. Most life science transactions happen at 20 times EBITDA or more, or higher. This business that was growing at 7 went to 2. Today, it's growing kind of high single digits, if not low double digits. So they've invested in it. That NIH business is growing at a healthy pace now. And so this is a company that essentially has generated very high returns on capital from deals, done it counter-cyclically, and essentially transformed the company from what it was a 3 to 4% organic growth company when I first started investing to the company, to what is today probably an 8% organic grower. So a company that was growing 3 to 4 and 10% EPS growth, today to an 8% organic growth company is more like a 15% EPS grower. It's been an amazing stock for us. Really, it should be a case study for anybody thinking about good capital allocation. Danaher is very similar. Danaher is very, very similar. This is a company, again, has double the organic growth rate of its company through very smart capital allocation, very high single digit, low double digit returns on acquisitions in year 5. The one thing that makes Danaher very interesting to me is they generated a lot of capital because they had very high free cash flow conversion. In many years, Danaher would generate $1 of earnings, but for every $1 of earnings they generate, $1.05 or $1.10 of free cash flow. So they had a lot of free cash flow to deploy, and they deployed it very intelligently. And as a result of that, they generate a lot of earnings accretion from that. And again, it's been an amazing stock as a result of that. AutoZone is probably it's an interesting name in that it's one of the best performing stocks for the last 20 years, but they never, their same store sales growth over this period of time was 2.2%. But they basically were trading for a very low valuation. They bought back a tremendous amount of shares, about 9% of the shares every year. And as a result of that, they compounded earnings at a kind of mid to high teens rate. Their multiple went up over time, and they were one of the best performing stocks in the market over the last 20 years as a result of that kind of strategy of kind of open stores, have modest same store sales growth, improve margins a little bit, have an optimized balance sheet, and take your share count down with all your free cash and all your debt capacity, and just again created a tremendous amount of value. AMETEK, a little bit different than Thermo and Danaher. AMETEK basically found these small mom and pop industrial assets, private companies. They buy them for 12 times EBITDA. They would double the margins over a couple of years by doing global sourcing, closing factories, maybe getting some family off the payroll, all that kind of good stuff. But they, 2 years later, the acquisition would be 12 times EBITDA, it'd be 6 times EBITDA. And the returns on capital in kind of year 2 or 3 was like double digits, which is great. And they also had very strong free cash flow conversion. Rowe Technologies, again, a company that, when I first picked Roper up as an analyst back in 2002 or 2003, this was an oil and gas company. It was a high-end kind of camera company. And they just took all their cash flow and invested it in high gross margin companies, negative working capital companies, and kind of niche software and healthcare companies. And again, compounded wealth at a kind of earnings perspective, like a 14% rate for 20 years. And their multiple went up as the quality of the underlying businesses went up as well. So I think Roper kind of compounded wealth at like a 16 or 17% CAGR over that period of time. All these companies did it differently. But what the glue that holds all these companies together is really good capital deployment, good free cash flow conversion, and again, massive amount of shareholder wealth creation for these companies. All right, so let me go to the next slide. So the question I would hope you're all asking now is, as investors, how do we find these companies to deploy capital well? And so when I first look at a company and I think about their capital deployment, I'm going to look at their recent acquisitions. Okay, you just bought that acquisition for $2 billion. What's the organic growth rate? Where are margins? What's the free cash flow conversion, that kind of business? And are the returns high single digits or low double digits in year 5, 6, or 7, right? Or are they low? If you're deploying capital and you're getting very, very low returns, that's we're not going to be interested in that, right? If you're buying back stock, essentially, are you generating good returns on that share repurchase? Have acquisitions made the company better? We talked about that with Danaher, with Thermo, and with Roper, right? All those companies basically used acquisitions to buy things that were faster growing, less cyclical, and theoretically improve their EPS growth algorithm. As a result of that, their multiple, the market will put a higher valuation on a company that has faster organic growth, less cyclicality, it should be lower beta, right? And faster EPS growth. So Danaher, Thermo, Roper, their earnings multiple from when I first got involved is anywhere between 50 to 100% higher. So you got the double whammy of strong earnings growth, but multiple expansion. So that's why these kind of companies were able to compound wealth in a mid to high teens kind of rate over a long period of time. So look for capital deployment that is improving organic growth, cyclicality, or EPS growth rate. Is the free cash flow return on invested capital increasing over time? Is R&D as a percentage of sales higher than peers? That's a good thing from my perspective. A company that has a higher R&D should generate more, should theoretically have more differentiated products than its peers, should be able to take market share, and that's a really good, drive faster organic growth rate. Whereas companies that deploy capital have higher capital spending than peers, not necessarily a good thing, right? We talk about high capital spending companies historically kind of destroy a lot of shareholder value. And then the last thing I would say just goes back to this point about this arbitrage that I talked about before. How much of the algo is coming from capital return? The more, the better. Because again, if you have an investor base that's obsessed with organic growth rate, they're going to put too high a valuation on organic growth rates, right? If you have a company that's generating like AutoZone was really, really cheap because their organic growth rate was not that high, but they were generating all this value through capital deployment. So they traded at a low valuation, right? But even though they were compounding earnings at a mid to high teens rate over a 20-year period of time, right? So essentially, the point is, the more capital deployment is driving the algorithm, probably the better opportunity. And again, the last thing I would just say, and I have it at the bottom, in general, not always true, but in general, companies that deploy capital well continue to deploy capital well. And companies that deploy capital poorly continue to deploy capital poorly. Not always, but I would say as a general rule, good rule of thumb. All right, let's go to the next slide. And I talked a little bit about this. It went too far there. So this is the kind of the total shareholder return algorithm. And again, as an investor, as an analyst, I would hope someday in the future, you'd be able to talk to me or talk to your employer, talk to your portfolio manager, your CIO, whoever it is, about this for any company, right? How fast does it grow organically? What's happening with margins? 25 bips of margins gives you 1 point to the algorithm. Zero margins give you 0 benefit to the algorithm, right? If you're just putting cash on the balance sheet, not adding a lot to the algorithm, right? Unless rates are much higher, which could happen, right? How much dilution is there in the share count every year, right? If you don't do anything. Sorry, the light just went out here. Hold on 1 second. All right, sorry, these energy efficient lights, I apologize. All right, but basically, if you look at, a company that just grows 6% organically, pays a 1% dividend, he has a little bit of margin expansion, you kind of get this 7% kind of algorithm. You're just putting cash on the balance sheet. That's what a lot of sell-side models might actually show in many cases, right? But the real question is, okay, we know all those metrics, but think about how much capital is the company deploying and how much incremental debt capacity you have. And I have this kind of calculation at the end, right? So company generating $2 billion of free cash flow, paying $500 million of dividends, and that's growing, so it has a little more balance sheet capacity, maybe $500 million incremental balance sheet capacity. So again, $2 billion of free cash flow minus $500 million of dividends plus $500 million of balance sheet capacity. You're earning a 6% return on that. 6% on $2 billion is 1.2, or $120 million, or $120 million of free cash flow minus a little bit of interest expense. How much does that add to the algorithm every year? And again, that's something that everybody should be able to talk about as an investor going forward. All right, let me go to the next slide in the interest of time. So, I do want to give some, I try to give some advice during these kind of discussions when I do these. So what is my advice for new investors with regard to capital allocation? No matter what sector you cover, no matter what firm you work at, seek out companies that do these 5 things, right? Or have these 5 characteristics. Good management teams. I'm happy to talk in the Q&A session about what makes a good management team. They deploy capital well. They generate good returns on their capital they deploy. And you can see that in the numbers. You can see that in history. When they talk about how they deploy capital, they talk about it in the right way, and it actually shows up in the numbers. They have low secular disruption risk. Companies that are going through disruption risk tend to deploy capital poorly, because the idea is trying to save the company, and that strategy kind of overwhelms good capital deployment, right? It's really hard to outrun secular risk, right? If you're competing with Amazon, if you're competing with Netflix, it's kind of hard to overcome those challenges. Companies that are trading for a reasonable valuation, right? And companies are, especially if they're out of favor for transitory reasons. If you can find companies with these characteristics and get these into your portfolio managers' portfolios, or own these from a portfolio management standpoint someday, the odds of you having a long and successful career in investing are quite high. It's actually kind of simple, right? Kind of simple, I would say. So let's go to slide 14. All right. So one of the questions I was asked in terms of preparing for this is like, well, let's talk about the role of boards. So why do most boards fail at capital allocation? Well, first of all, if you look at most boards, there's not a lot of capital allocation experts on the boards, right? There's a lot of companies that are maybe innovative experts, maybe they're government affairs experts, maybe they're really good at accounting, maybe they're really good at strategy. But if you look at most boards, there's not a lot of people who are kind of capital allocation experts. I did an analysis of the largest 20 companies in the S&P 500, and I would say probably 1 out of 7, 1 out of 8 had any kind of capital allocation expertise on those boards, right? So it's just not what most boards are good at, right? It's not what they're built for. I think most boards kind of have this view that bigger is better. You bring me an acquisition, that's good, right? Bigger is better. That's not always true. AutoZone, in many cases, kind of showed that, new stores, modest kind of comps, take your share count from 150 to 25, you can create a tremendous amount of value, right? There's a lot more value than getting bigger. Again, boards are really good at strategy. Boards like talking about strategy. Let's get bigger in Europe, right? Let's get bigger in the sensor business. Let's get bigger. That's a strategic hole. That's a white space we need to fill. Boards are good at that kind of stuff. So if they want to do those kind of transactions, right? So if it fits a strategic itch or strategic need, it's okay. That's the attitude with boards. I'll talk about books at the end, but I'm a big fan of Daniel Kahneman. And again, everybody should read Thinking Fast and Slow. And it talks about this idea, the inside view versus the outside view. The inside view is the view that people have in all decisions, how we make decisions in life, right? The inside view is based on the views of a couple people who are not disinterested parties, right? What's going to be the growth rate of this acquisition we're acquiring? Well, I think it's going to be 15, okay? The outside view is based on history, more data points. Like all the acquisitions have been done in this space that had acquisitions that were growing 15% before. What happens to the organic growth rate of the company after you've acquired them? Is it still 15 or is it 5, right? And the outside view, which is more data-driven, tends to be more accurate and have less biases in it than the inside view. So what you'll see is, talking to people who used to be on boards, a management team will put a spreadsheet in front of them, says 15% growth, we get a good return in year 5. But that's the inside view, right? What if you put a 5% growth rate and returns are really poor? Again, they're kind of, the boards are a little more focused inside versus the outside view. Again, this idea of cost of capital, I think in many cases, cost of capital is a crutch for many companies on a board. Many companies have options, whether it be share repurchase or acquisition, smaller deals, dividends, to generate returns that are more attractive, more attractive than their cost of capital, right? So many companies have multiple options to generate returns above their cost of capital. And it's not just picking a capital allocation alternative that's as above your cost of capital, but finding the one that has the best return, the best risk-adjusted return. That's really what's key. When cash flows are strong, like in semiconductors today or energy a couple of years ago, they tend to lower their return thresholds, right? We have a lot of cash coming in the door, let's deploy it, right? Return thresholds kind of come down when there's a lot of cash in the door. And investment bankers are they're not bad people, but they're very incentivized to action. So you're looking at acquisition, you bring the investment bankers in. They're not impartial people. They're not impartial sources, right? Take everything they say with a grain of salt. Most boards don't do that, right? So these are all the reasons why capital allocation tends to fail at the board level for many companies. So I'm going to give one example here, and I'll go through it quickly in the interest of time. Mondelez was thinking about buying Hershey. And actually, I think they made a $107 offer a couple of years ago to buy Hershey. Now, this was, from a strategic standpoint, it made a lot of sense, right? If you go to Europe, you don't see a lot of the same chocolate you see in the US or in Japan, right? It's very different. It's a very different kind of candy bars kind of mix, maybe exception of Kit Kat. So the idea was, hey, Hershey's really strong domestically. Mondelez, which owned Cadbury, is really strong in Europe. Put them together, we have this global chocolate company. That's great, right? It sounds great from a board level. The challenge was it was going to be only modestly accretive and far less attractive from an earnings perspective than if you just bought back stock. The returns on capital would have been very, very poor. They wouldn't have generated a return even equal to the cost of capital to year 8. They would have reduced their financial leverage. They would increase their financial leverage, and it would really limit their ability to do anything else for at least 3 or 4 years. By buying Hershey, they would buy a big domestic chocolate business, which is structurally slower growth than chocolate in emerging markets, so they would dilute the growth rate of the company. And then management time and attention would be really focused on this acquisition for the next couple of years. So you'd be integrating these 2 deals. And I actually even mentioned, Kit Kat. Mondelez would probably lose their proprietary rights, or their rights to Kit Kat brand. So it was like it fit the strategic needs, this deal, but on every other dimension it was horrible. Every other dimension was horrible, and so thankfully this deal did not happen. I kind of refer to this as kind of the curse of the white space. So you can do strategic deals, but make sure you earn good returns as well. And so again, this really goes to the point of having a good CFO protecting long-term investors. So again, the board's very focused, maybe even the CEO is very focused on doing strategic things. What the CFO needs to come in and say is, okay, I understand it's strategic, but is it still a good return? So again, it's easy to deploy capital. Generating really good returns is the hard part. So what will a good CFO do? A good CFO will kind of build a deal model to the 50th% outcome, that there's an equal chance it's too conservative or too aggressive, right? I think a lot of these deal models that are put in front of boards, they're at the 90th percentile, right? It's really high odds that it's the best case outcome, not the 50th% outcome that this happens, right? They'll ask themselves, is this better than buying back stock? Is this better than doing a whole bunch of small bolt-ons, right? Does this capital allocation make us better? Does it increase the organic growth rate of the company? Does it reduce our cyclicality? Does it increase our EPS growth rate? They'll never model in revenue synergies. Revenue synergies almost never materialize. And they'll assume normalized end market demand. Again, we talked a little about semiconductors. Semiconductor demand over the last decade has grown 4 to 5. And you hear a lot of semiconductor companies talk today. It's like, it's going to grow 10 forever. That's probably not the right way to be thinking about it. That's not the 50% outcome in terms of approaching this going forward. All right, so the last 2 slides, I'll go quickly. Additional advice for new investors. When I talk to new investors, younger investors, their focus, their personal investments, their questions, they're all around these exciting stocks. They want to talk about Tesla, they want to talk about crypto, Apple, GameStop, Amazon, Starbucks, Netflix, Nike, SaaS software companies. Yeah, that's interesting stuff, but I think there's almost like a little bit of a gambling element. These are high vol stocks, move all over the place. They're in the news. However, as an analyst at T. Rowe or anywhere you go, it's highly likely you're not going to be covering these kind of stocks, right? Again, I said most of the market is somewhat mature. I looked at this the other day. About 95% of our analysts don't cover these type of stocks, right? What I would tell you, again, you need to differentiate yourself among all these other people who are trying to get a job in this industry, right? What I would say, learn and study utilities, industrials, banks, healthcare. When you come and are trying to get a job at T. Rowe or somewhere else, don't pitch us on Tesla. Don't pitch us on Team. Don't pitch us on Snowflake. Pitch us. Talk about this really good utility and what's special about it, and how you create value in utilities. Talk about this really attractive industrial that deploys capital really well. Differentiate yourself from the pack and learn how one mature company differentiates itself from its peers, right? Don't talk to us about crypto. Don't talk to us about Amazon. Don't talk to us about Starbucks. Talk about something that's a little bit, that's going to differentiate yourself in the eyes of your potential employer, I would say. Last thing I would say, investment books. So part of the way I got my job at T. Rowe back in 1998 was I was going to differentiate. I went out, I read 40 books, helped build my foundation from an investor. I wasn't obviously, I didn't know nearly what I knew today, but at least I knew the idea of margin of safety, balance sheet, statement of cash flows, earnings quality, the idea of contrarian investing and how hard that is sometimes. And so I would encourage people, don't just take finance classes. Don't just invest in your PA. Read really good investment books that help build a foundation to make you a good investor down the road and honestly help get you a good job in the future. So I have a couple of these books. I've already talked about kind of thinking fast and slow, this idea of the inside view and the outside view, that Daniel Kahneman, who's a Nobel Prize winning, he's actually a psychologist, but his book's more about economics. The Intelligent Investor, the idea of margin of safety, Ben Graham, really the father of security analysis, father of value investing. The security analysis, there's 5 different versions of security analysis. The best version is the second edition, 1940. Ben Graham and Dave Dodd. Again, if you're just looking, I always think Peter Lynch's One Up on Wall Street it was a pretty good book. It's a quick read, but it just helps you understand a little bit of what we do on a day-to-day basis. The Berkshire Hathaway Annual Report Letters by Warren Buffett. Really good. I would say they probably come less good last 10 years as he's aged a little bit. But I would say if you go back to kind of from the 70s to the early 2000s, those were really good. Black Box Thinking. I'll pitch my own book here, Capital Allocation, from McGraw-Hill. I wrote here, came out this year or last year. And then Think Twice, Harnessing the Power of Counterintuition by Mike Mobison. He used to work with Bill Miller at Lake Mason, a really good book. Again, maybe the only last thing I would just say is, I kind of highlighted this multiple times. If you want to be successful in this job, in this industry, you got to do things that are different than everybody else, right? You have to think, you have to zig when other people are zagging, right? When things feel good, you got to be taking risk off. When things feel horrible, you got to be putting risk on, right? When the stock's out of favor for some transitory issue, you got to be all in on those stocks. You really have to build a business model for yourself as an investor that's differentiated from everybody else, or you're never going to create real value for the shareholders or as an analyst or whatever you want to do in your career. So, all right. So I know I've talked for 55 minutes. I know we probably have time for a little bit of Q&A from Grace or Jacob. Do you want to lead that process? I don't know if I can see the Q&A. Maybe I see the Q&A. I do see, actually, I see a question in the Q&A session, so maybe I'll answer from a couple of people. So the question is, on a risk-adjusted basis, do the returns of these companies look equally impressive? And I would say what you would find actually is they do. What's interesting is, Danaher, Thermo, Roper over time we think about the risk-adjusted returns. It's not only it's not only the return generating, but actually, if you buy a good company, in many of these cases, you buy a good company and you improve the margins, the risk of actually having poor outcome is actually quite low. One of the mistakes that GE made in the 2000s, 2010 period of time was this idea that they were buying bad businesses, right? They're paying high valuations for bad businesses. So the risk-adjusted returns of those on a forward-look basis were poor. Also, in many cases, again, when you lower the beta of when you lower the cyclicality of your company, which all these companies have done, honestly, most of these companies, again, auto industrials are a lot less cyclical than smartphones in many cases, or healthcare is much less cyclical than industrial, right? Or software is much less cyclical. You reduce your beta, which theoretically should increase your the multiple the market's willing to pay for there. So all these companies, I think the capital deployment in AutoZone, again, was always a very low cyclical company. So the returns on capital were good. The risk-adjusted returns were even greater, right? When we think about risk-adjusted returns, I think of the concept of, if I decide to go into Venezuela or Argentina and make an acquisition, there's a lot of volatility in that market, a lot of currency risk. If you're going to make an acquisition in that space, you need to make really high returns to justify that, versus doing share repurchase, doing a small bolt-on acquisition, adding a new line. Those are a little bit lower risk. So I think all these companies, the capital deployment has been very, very good. So, okay, let me see other question I'm seeing. How would you go about allocating sectors in a portfolio against the S&P 500 benchmark? Which sectors would you over or underweight in the near future? One of the things I would say is, it changes over time, right? It changes over time. So again, there's think about something like healthcare. Healthcare is a sector. There's all these other subsectors within healthcare, right? So pharma's not a good sector. Pharma's a tough business. So it's a really tough business. You're basically on a treadmill because your patents roll off every 12 years. It's a tough business. Whereas life science tool companies like Thermo, Danaher, Perkin are great companies, right? So I don't tend to think about sectors. I tend to think about sub-industries or subsectors, and what are the best subsectors to invest in. So we kind of like things that we like are kind of life science tools, industrial conglomerates are really good businesses. The rating agencies, insurance brokerage is a good sector. But we don't think about, I want to buy financials, or I want to buy energy, or I want to buy healthcare. We tend to think about it on an individual company basis, and there's usually nice niches within those sectors that are really attractive. So hopefully that answered that question. So what defines a good management team? I think a good management team that is a couple things. They're focused on the right things. They're focused on the shareholder, right? They are doing the things that will allow them to grow at or faster than their end market, right? They're deploying capital well. They are helping to generate an attractive and a culture that people want to work at. We can see a lot of that now with Glassdoor, right? You can see that in the Glassdoor ratings. There's some companies that are horrible on Glassdoor, some companies are great. So that culture is really important. T-Rowe, one of the reasons why I've been at T-Rowe for 22 years now is the culture is so great. So great at actually 24 years. I'm sorry. The culture is so great at T-Rowe. So so investing to grow, making long-term investments, deploying capital well, and honestly, people who can articulate their business quite well, I think is also what they're doing is important from a management team perspective. So I think those were most of the questions I've gotten in the Q&A here. Any other questions? Or am I out of time, Grace?
I think you're just about out of time, but thank you so much for coming today. Thank you to our moderator, and have a great day, everyone.